Hello, Clive Tompkins reporting for the Finance News Network. Joining me on the 3-year anniversary of the Northward Equity Income Fund is Portfolio Manager Darren Thompson. Darren, welcome back and congratulations on the first 3 years of operation. First up, can you start by introducing the fund?
Thanks, Clive. The Northward Equity Income Fund is a portfolio of quality stocks which our investment team feels are undervalued, and then we in turn sell option premium over those stocks to generate consistent income. So we sell options to others who are trying to buy upside. The attraction for the fund and for investors in the fund that generates a consistent income stream which we add to the dividend income and the franking credits that the fund generates to produce our targeted 8 to 10% per annum income. And that's what the fund has delivered over the period of the 3 years since we've been running.
How would you characterise the last 3 years, and were there any surprises?
Look, it's been an eventful 3 years, although probably the last two seem reasonably benign because the market's been quite strong. We launched in a period where the market was down quite significantly. So within the first 3 months after operation, the market actually was down 15% at one point. So it was quite an eventful period. And pleasingly, the fund has performed to expectations through those very different market conditions. As an example, when the market was down 15% in the early days, our fund was down only 2%. So in keeping with the fund's strategy, there's a very strong capital preservation focus, and that goes to the option writing that we do and also the hedging that we take over the overall portfolio. Certainly then, as the market's grown, we quickly reclaimed that capital and moved into the black and have generated consistent income over the 3 years. But certainly we have lagged as the market has, in periods when the market grew very strongly.
Darren, now to the derivative positions within the fund. What has been the contribution of options income to the total return of the fund?
It's a good question. So as I mentioned, the key to the success of the fund in our view is that it generates income from multiple sources. So we hold a portfolio of stocks which generates dividend income, generates franking income, and also there's expectations of capital growth which we've delivered over a period of time. The options that we write, again, we would write options over about 80 to 85% of the stocks we hold, and that generates about 4 to 5% per annum, or about 40 to 50% of the expected return of the fund.
And what about the last 12 months?
Yes, and so certainly it's been in that 40 to 45% mark over the last 12 months. It's worth noting that there's some attractive offsets in the way the fund operates. In periods where markets go down, volatility tends to go high and you get more option income. In periods when markets are strong, although the option income comes down, you get compensated for by way of capital growth. So that helps to produce that steady income that we're looking for. Now,
the fund also purchases index puts for protection. What does this mean for the fund in terms of exposure to the market versus a long-only fund?
Yeah, no, good question. So our expected market exposure, or our target market exposure, around 50% of the market. And that means that the fund exhibits far lower volatility than you would get if you invested directly in the stock market. And part of that strategy is our hedging. So certainly in our view, and I alluded to the fact that when the market was down 15% in early parts of the fund's history, we were down 2%. That goes to the hedging strategy that we put in place. That means that we buy a put over the overall market, which means we have the right, but not the obligation, to sell if the market falls, and that in turn provides some protection if the market actually does go down. So it's a little bit like insuring your house or your car, provides that safety net and that peace of mind.
Great. So how much does that protection cost on an annualised basis?
The overall cost of putting the hedge in place has been 1.6% per annum over the life of the fund.
Darren, the SMF sector is the largest segment within superannuation. What impact are SMSFs having on the top 50 stocks that your fund invests in?
I think that SMSF trustees are putting a greater allocation to equities, as are retail investors at large. And I think they've tended to move into names with which they're familiar, which is quite reasonable. You know, the large four banks, Woolworths, Wesfarmers, Telstra, they're names which I think trustees and retail investors gravitate towards. So I think that is having a modest impact in terms of pushing prices of those stocks towards reasonably full levels. I guess our task is obviously to identify value continually in the market, and we certainly focus on and research a deeper pool of stocks, and we also have the ability to write options over those other stocks as well. So that's where we're looking to, I guess, compete against those investors in terms of generating superior returns.
Last question, Darren. If this isn't unreasonable, what does the next 3 years have in store for equity income funds?
Okay, thanks, Clive. Look, I think essentially the trends around investors' desire for income will continue to grow and become stronger. You know, the demographic trends with an ageing population are only going to continue to exacerbate that trend. And certainly I think that alternate sources of income, whether it be cash or term deposit, in our view, are not likely to rise rapidly at any time in the near future. So with that in mind, with the demand being strong, with alternate sources of income being more modest, I think investors looking for income with a view with lower volatility and lower risk means that equity income funds should have an increasing place in investor appetite and an investor asset allocation.
Darren Thompson, thanks for the update and congratulations again on the first 3 years.
Thanks very much, Clive, and look forward to seeing you in another 3.